Hello and welcome to this explainer. Today, we're going to explore the true price tag of corporate funding, and we'll learn exactly how businesses go about stocking what I like to call the capital supermarket. I am super thrilled to guide you through this because, let's face it, understanding how money is priced is the absolute bedrock of business finance. Let's get right into it. So let's kick things off with a pretty fundamental question. Is money ever truly free when a business needs to grow? Think about it. When a company wants to build a massive new factory or maybe launch a brand new product line, they need capital. But does that capital come without strings attached?
Well, the short answer is no. Money is literally never free. The cost of capital is simply the return rate a firm absolutely must earn on its investments just to satisfy its investors' required rate of return. You see, if a company raises funds, they're implicitly making a promise, right? A promise to generate enough revenue to pay for the sheer privilege of using those funds.
And this is absolutely crucial, because mastering these precise equations unlocks a company's ability to make massive, existential choices. By understanding the cost of capital, management can make highly informed investment decisions, actually deciding which projects are worth funding in the first place. It also dictates capital structure decisions, like figuring out exactly how much debt versus equity to hold. Plus, it directly impacts dividend policy decisions. It's basically the financial compass for the entire firm.
Okay, here's our roadmap for navigating this capital supermarket today. We'll be looking at 1. The price of money, 2. The cost of debt, 3. Pricing preferred stock, 4. Internal equity expectations, and 5. Why this all matters. Let's start with Section 1, the price of money, and understanding the capital supermarket.
So notice how different funding tools have different rents or price tags attached to them. When a firm issues securities, those sources bear a very specific cost. For instance, debt costs you interest, which is basically a payment out to your bondholders. On the flip side, shares, whether we're talking preferred or common, cost you dividends. The overarching concept to remember here is that these payments out are the direct costs weighing against your revenue.
But before we start calculating those specific costs, we really need to establish a strategic contrast that applies across our entire capital supermarket. We basically have two main flavors of capital. On one hand, we have perpetual, meaning it has no specific maturity period. It's permanent borrowed capital, sometimes called irredeemable. On the other hand, we have redeemable capital, and that comes with a specified maturity period and a strict expiration date. Keep this distinction in mind as we move forward because it literally changes our math entirely.
Moving on to Section 2, the cost of debt, borrowing with a price tag. Let's start with the permanent kind of debt. For perpetual debt, the formula is beautifully simple. The before-tax cost of debt, which we represent with the variable KD, is just dividing the annual cost by the actual money you received in hand. So you simply take the coupon interest, I, and divide it by the net proceed, NP. It really is that straightforward. No crazy math here.
And finding that net proceed isn't some abstract algebra problem either. It's just a simple two-step process. First up, you calculate your selling price by taking the par value and adjusting it for any premium or discount. Second, you find the net proceed by taking that selling price and subtracting your flotation costs. In case you're wondering, flotation costs are just the fees associated with actually issuing the debt.
Now we can easily tame the much more complex redeemable debt formula by first chunking out 4 really simple variables. M is your face value or maturity value. I is your coupon interest. NP is that net proceed we literally just calculated. And N, well, that's your maturity period, basically the lifespan of the debt. Once you have those, you just plug them right into this equation to uncover the true cost of debt over its specific lifespan. Okay, I know, it looks like a total mouthful. But logically, it simply takes your interest, adds the premium you'll pay at maturity spread out over N years, and then averages the total cost. It perfectly spreads out that financial weight over the lifetime of the redeemable debt. But hey, remember this, debt actually comes with a hidden financial advantage. Because interest payments are typically tax-deductible, your after-tax cost of debt, which we call KDT, is simply your before-tax cost multiplied by 1 minus the tax rate, T. This neat little trick makes debt inherently cheaper after you pay your taxes. Real game changer.
All right, Section 3, pricing preferred stock, satisfying the investor.
Just like perpetual debt, perpetual preferred stock gives us a super clean, easy formula. To find KPS, which is the cost of preferred stock, you simply divide the preferred stock dividend by your net proceeds. It is honestly incredible how closely this mirrors our very first debt formula. It's the exact same logic at play, the required payment out divided by the actual money you brought in. However, when preferred stock is redeemable, meaning it has a firm expiration date, the math gets just a little bit more rigorous. The exact computation uses present value interest factors. Essentially, that means it perfectly discounts that future stream of dividends back to today's dollars, which naturally accounts for the time value of money. But if you don't want to deal with calculating exact present value factors, we can totally use this approximate formula instead. And notice how elegantly this mirrors our redeemable debt formula from earlier? We just swap out the interest for our preferred dividend, DPS. The entire structure of spreading out those maturity differences remains exactly the same. That brings us to Section 4, Internal Equity Expectations and the Cost of Keeping it Internal. So, to figure out the cost of internal equity, we rely heavily on the discounted cash flow approach. Now, in finance circles, this is widely famous as the dividend growth model or sometimes the Gordon model. It's a brisk, fundamental way to understand exactly what return common equity investors are expecting based purely on cash flows. And guess what? This gives us the absolute simplest formula in our entire explainer today. The cost of internal equity, KS, is simply D1, which is the expected dividend, divided by P0, the current price of the stock. It brilliantly boils down all those complex investor expectations into a single, easily measurable fraction. How great is that? Let's wrap things up with Section 5, Why This Matters, bringing it all together. You see, by understanding the individual specific costs of debt, preferred stocks, and common stocks that we just walked through, a firm doesn't just stop there. They combine all these components. They weigh them together to find the overall weighted average cost of capital, commonly known as WACC, as well as the marginal cost of capital, the MCC. This combined rate is the ultimate financial hurdle the firm absolutely must jump over if they want to create value.
So, knowing that money is never, ever truly free and that every single source of funding has a strict mathematical price tag attached to it, whether that's the interest on a bond or the expected dividend of a stock, how will you choose to stock your corporate shelves? If you were the one running the firm, which mix of debt and equity would you choose to guarantee your company's future? Think about that for a bit. Thanks so much for joining me on this explainer, and keep exploring.